Hello everyone, and welcome to lesson 1.7 on interpreting order flow, aka your time and sales window. This is a difficult concept for most new traders to master, so don't feel discouraged if the concepts in this lesson aren't immediately apparent to you. Practice them as much as you possibly can, and eventually I promise you'll get a feel for it. So with that, let's hop into the lesson. Okay, so in today's lesson, we're going to start off by just covering the absolute basics of time and sales. We're then going to talk about the different print types that you'll see, along with the different participant types that you can differentiate between. Finally, we'll talk about how you interpret the different participant and print types and can actually use them to potentially predict what might happen next in the market. Before we get into the detail of today's lesson, I want to reiterate one more time that this is a very difficult skill to learn. The speed at which transactions are passing by on your time and sales window can be very overwhelming, particularly to new traders. Therefore, when you're focused on building out this, quote-unquote active trading toolkit, I want you to focus on learning the skills that I have laid out in these lessons in the order that I've laid them out. I specifically released them and I specifically labeled them in this order because I truly believe this is the most effective way to learn to trade. So you're going to start with price action analysis in lesson 1.1. You're going to move on to then layering in volume analysis in lesson 1.2. Then you're going to focus on order book analysis, which we covered in the previous lesson to this one. And then finally, you're going to focus on your time and sales window. That'll really help you dial in specifically around the actual execution of your trades. So with that, let's get into the actual detail of this lesson. Okay, so we'll start out today's lesson super basic with just how you read and interpret the time and sales window. The time and sales window on your platform records all transactions that are executed in the market. You get a couple of key pieces of information such as the time and the price of execution, but in my opinion, there are two very critical pieces of data that we get from the time and sales window. The first is where the order was executed in relation to the bid and ask. The second is the quantity of shares transacted. So over here to the right, you can see an example of my time and sales window. And then down here is my configuration settings. So you can see that for orders that print above the ask, I color them blue, at the ask is green, inside the bid-ask spread is white, at the bid is red, and below the bid is this yellow color. So if you look up here, you can see that we executed at the bid an order at 98.56 for 126 lots, so this would be 1,260 shares at 10.52. So that's how you would read and interpret this window. So, yes, every transaction represents both a buy and a sell, right? I'm not saying that red is sellers and green is buyers. It's not that simple. However, the color of these different prints and the size of the order can give us very valuable insight into the psychology and the type of participants involved. So let's dive into the idea of psychology and having different participant types involved by first looking at red prints. Red prints are those that were executed at the bid. So you have your bid-ask spread. These are down here at the bid. It is critical to remember that this can represent basically three different scenarios. So when you see a red print, it could either be an impatient seller, which is looking to immediately exit their position. So you bought earlier on, or you bought right at the top and you're exiting for a loss, but either way you want to exit on a market order. Therefore, you will show up as a red print because market sell orders show up at the bid. Second, you have an initiative short seller. Now, an initiative short seller, they're wanting to get into a position now, immediately. So they do that on a market order. Once again, they're selling with a market order. They will show up as a red print at the bid. The third participant type, which is probably the hardest to specifically analyze just based on the color of the print, is the limit order, or kind of the patient buyer or seller. These people are waiting for a price, a specific price, to get hit. Okay? Now, I have a quick little aside on limit orders because some people will say, oh, if it's a limit buy, it should be green, or a limit sell, it should be red. Technically, yes, that's true. If you are executing a buy on a limit order, you should show up as a green print. And if you're executing a limit sell, you should show up as a red print. However, I have an entire appendix slide at the end of this lesson that shows that that's not always the case. So if you're interested in diving into that more, you can watch that slide at the end of this lesson. However, the point here is that you have two very impatient participant types and one potentially very, very patient participant type. So we'll use price action, where we're at in terms of support and resistance, and what our level 2 is telling us to determine which of these different participant types are involved. So now we'll look at the flip side of the bid-ask spread by looking at orders executed at the ask. These will show up as green prints on your time and sales window. It is once again important to remember that this could represent 3 different scenarios, all with different psychologies and participant types. So your impatient scenarios in this instance could be impatient buyers. So you're looking to enter a position right now, so you'll do it with a market order. If you execute a buy with a market order, you will show up as a green print, or you'll show up as a blue print because you executed above the asking price. The second group would be impatient shorts. These are essentially the exact same as impatient buyers in that they'll show up as a green print because they're covering their short position with market orders. So fundamentally, those are executed the exact same way. The third participant group is our patient group, and these are executing on limit orders. So once again, they're patiently waiting for a specific price point to get hit. Now, as we said on the previous slide, we will use price action, support and resistance, and our level 2 to help us identify when we see green prints which of these scenarios is taking place. All right, so we have talked about red prints and we've talked about green prints. Let's now talk about the in-between, the white prints. These are prints that are executing inside the bid-ask spread. So you have your bid price and your ask price. These are somewhere in between those two. White prints will be more common on stocks with higher bid-ask spreads, which makes sense, right? If your bid-ask spread is 50 cents, it's much more likely that you'll have prices executing in between the bid and the ask than if your bid-ask spread is 1 cent. Now, in terms of the participant types involved, it's important to recognize that white prints are typically dominated by computer algorithms. And the way that you can tell this is the case is that you'll see these executed at fractional prices that we as humans and retail traders typically can't trade at. Most brokers limit you to 2 decimal places when you're entering an order, but you'll see these order types, which you can see here and a big cluster down here, with multiple decimal places. So this one is executed at 98.5411. No human is sitting there entering that order. Now, recognizing that these algos are taking place can be a valuable insight in and of itself, right? Because you know that probably these algorithms are executed by people like market makers or large institutions and therefore represent the smart money. So while we can't break the participant types out as cleanly as with green or with red prints, just recognizing that it's probably computers doing the trading is a valuable insight. All right, so that brings us to the last print types that I want to talk about. And those are the blue prints, or ones that execute above the ask, and the yellow prints that execute below the bid. And I show you examples of each of those here. With these print types, either above the ask or below the bid, it is important to recognize that retail traders like you and I don't really have the privilege of trading outside the bid and the ask. So one party in these transactions is getting a much better fill than what is available at the bid-ask spread. Spoiler alert, sorry to tell you, it's not going to be you. So all of the previous situations from our other slides, right, the impatient buyers, the impatient sellers, or the limit orders, all of those apply. But the key now is to recognize that the two parties involved are very different. The first party are the suckers, and that's you. I'm sorry to tell you, that's just the way it works. These people are getting the worst possible fill, most typically on market orders. So when you do a market order for a buy and you're on a platform like Thinkorswim where you don't have to pay commissions, the reason you don't have to pay commissions is a concept called payment for order flow. So your order is being sent to a market maker and they're filling you purposefully at worse prices. That's how your commissions are free. So if you buy on a market order, you are probably getting filled above the ask, at least in a lot of different situations. So you're actually this blueprint. Now, the second participant type, which again we've already kind of talked about, are the institutional participants, like market makers or those that just have better fill priority and faster technology. So when you look at these bid-ask prints, it's important to recognize that smart money is involved and it is essentially being sold or being bought from people that are kind of more on the retail side of that equation. The last thing I'll say is that these orders are commonly executed at fractional prices. So once again, we can kind of think about computer algorithms or institutional traders being that participant type. The last thing that I want to go over on above the ask and below the bid prints is that it is commonly taught that these prints represent kind of panic selling or panic buying. And I think that that is true in terms of you will see these orders more frequently when the market is moving extremely fast. However, I want you to keep the mindset of the fact that one side of this transaction is smart money and one side of this is people getting poor fills. And I want that to be the main takeaway, not necessarily saying that, oh, if you see blueprints, it must mean that, the market's going to explode upward because people are getting filled on market orders. That's definitely not the case, and definitely not even the case the majority of the time. So just wanted to put that one more additional comment in here, and now we'll move on. Okay, so now that we've talked about the different print types and their relationship to the bid-ask spread and what that might tell us about the participants involved, I now want to show you how you can further differentiate the participants involved by splitting your time and sales window into multiple groups based on share size. So what I do is I actually have 2 time and sales windows on my platform that I'm paying attention to. I have one for kind of small retail traders or even kind of high frequency algorithmic trading that is just filtered to anything over 100 shares. The second window I have is filtered to anything over 1,000 shares. And I would consider these, institutions or large prop traders. By splitting my time and sales into these groups, you're able to show when kind of the larger or smart money disagrees with the small traders, right? You can see when volume picks up on your large time and sales versus when it picks up on your smaller time and sales. So, for example, if you're seeing a very high number of orders come through on your larger time and sales window, at a support or resistance level, this could be a significant signal that at a very bare minimum level, these large players also agree that that level is important and are making decisions there. So we'll go into some examples of this next, but just want to show you how you can split your time and sales windows up to differentiate these different participant types. Okay, so now that we've learned all about the different participant types and the different print types, we're going to try to put that into action. And so, as I've said, the time and sales can be very difficult to interpret. And as you'll see in these examples, and as you've maybe already seen in your own trading, it moves very quickly. So to combat this flood of information, what I try to do in my trading is narrow down to basically 3 main scenarios that I'm trying to identify utilizing the time and sales. So these scenarios might be slightly different for your own trading. And what you can do is you can identify key points where you would have wanted to take a trade and then go re-watch them in replay mode to identify what the time and sales was doing at that level. But for me, basically what I'm trying to do is identify one of these 3 scenarios in combination with the other things we've already learned in this course. So for me, the 3 scenarios are price holding or rejecting a key level, price pulling back and retesting before continuation, or 3, a weak squeeze or flush that could be designed to trap or hunt retail traders. So if I can successfully identify these 3 things when they're happening live in the market, I can greatly increase my accuracy and I can limit my usage of the time and sales windows to specific moments in time, so that I'm not constantly looking at it and getting a little bit of analysis paralysis with all of the information flowing through. So let's look at an example of each of these next. Okay, so the first scenario that we're going to take a look at is price holding or potentially rejecting a key level. As you'll see in section 2 of this course, a lot of my strategies are based around either kind of the acceptance or the rejection of a key level. So in this scenario, we're looking at what happens on your time and sales window when you get a rejection of that level. So the things that I'm looking for on my time and sales as we approach a level, and again, I'm not looking at my time and sales until we get to that level and I see, volume anomalies and I see the other things that are happening that we've learned about previously in this course. But when I key into my time and sales, I'm first looking for a velocity of both large and small traders hitting the time and sales while price stalls out. Okay? The second thing that I'm looking for is orders flashing above the ask if you're at a top side level or below the bid if you're at a bottom side level. And once again, you want this to be happening while price is stalling out. And remember back to our previous slide, these blue and these yellow orders are examples where basically, retail traders that are paying, they're not paying for commissions, so they have free commissions. So their payment for order flow orders are being sold to institutional clients and market makers so they get the best possible fill before these levels reject and prices reverse. The third thing that I'm looking for is an increase in volume and continued velocity as we move away from the level. So if we're failing off of a topside level, I want to see flashes of red and white orders, and I want to see many more of those than I see green orders. And let's say if we reject a bottom side level, I want to see green orders stepping in, right? People hitting the ask, people being impatient to get into a position, and more white orders. So those are the three things that I'm looking for, and you can use this for two key things. First, you can use it for reversal trades, so as a signal to enter a position, which is what I did over here on this trade of Tesla, which I'm going to show you a live example of. Or if you're already in a position, you can use it as a signal to partial or entirely exit your position. So now let's look at a live example of Tesla. Okay, so I've got a recorded example of Tesla that I'm going to show you of this first scenario where price is kind of rejecting a key level. And in this instance, the key level is pre-market high, which is represented by this gray dashed line right at 205. So it tested this level in the pre-market, and now it's coming up to test it again after the market is opened. Now what I've done here is exactly what I recommend that you do when you're trying to practice this skill. I've gone back in the replay mode of my platform, and I've identified this key moment, and now I'm going to be watching it over and over again to get a feel for what my two time and sales windows are doing as this rejection takes place. So I'm not trying to learn this skill live necessarily, right? I'm going back in time and I'm allowing myself to remove every distraction other than just watching my time and sales window. So let's take a look. So here we've got this little doji candle that's going to form, and you can see that as we push up into 205, every time we push up into 205, we get a flash of orders on both of our time and sales windows. Okay, so you see orders that are above the ask, you see some limit orders getting executed right at 205, and then you see, again, a large flush of orders on your retail and your institutional level time and sales every time we hit that level. Yet we're not breaking through it. So there's a ton of activity, but there's no movement in price. So think back to our lesson 1.2 on volume analysis. You have a doji candle right here on kind of above average or very, I would say high volume for a doji candle. And you have a stall in price as both of these time and sales are flashing by. So let's take a look. I'm actually going to skip forward a little bit. Let's take a look what happens as we kind of get our final rejection on Tesla here. So there we go. We're pushing up. And did you see how both of these flashed? Right at 205 basically. And there was no breakthrough of that level. That's a key signal that, hey, potentially we're going to get a pretty drastic flush in price. And here you see, boom, we get that flush in price. Both of these windows accelerate. All right. And you can see mostly white and red flashing across as we fail lower. Huge. Yep. I mean, look how fast those sped up. So a pretty perfect example here of what to watch for on your time and sales. And again, anytime you identify one of these out in the wild, just write it down on a piece of paper and go back and watch it over and over again to practice the skill set. Okay, so we talked about rejection. Now we're talking about the second scenario, continuation. And again, as I said, a lot of my strategies are based around kind of the acceptance of a level and then continuation away from it. So with this particular play, again, I've approached a key level, or I've already pulled back to a moving average, and I've started to key into my time and sales. And now I'm looking for these four things. The first is slow or weak order flow on our larger time and sales window during a pullback, right? This shows that these larger participants, one, aren't shorting, and two, aren't panic selling as we move back in price. They're convicted that we're going to move higher, and so they're holding. You will commonly see a flash of large orders when you hit kind of the moving average or the pullback area or the retest of a level, because these people are now entering a position for the move higher, or they're adding to their position. The second thing you want to see is good solid speed and volume of orders coming through when you push. Okay, so as you push away in price on that second move up, you should see, again, if you're moving up, you should see a lot of orders hitting the ask, which means people are entering on market orders because they're impatient, they're FOMOing, they're trying to get into the move. What you should not see is anything from our first scenario. So you don't want price to be stalling, longer than 1 to 2 minutes while you see a flash of green or even blue orders if you're moving up, or red or yellow orders when you push down. Fourth, remember back to our second lesson on volume analysis where we said volume equals effort. Okay, so all of these things essentially translate to seeing a push velocity, so increase in volume as we push, volume equals effort, and slower volume on the pullback. Okay, so we should see our continuation volume profile from lesson 1.2. So now let's look at an example of that where we could use this as conviction to either stay in a trade or to enter a trade long on the retest of a level. Okay, so now I've got my live recorded example of Apple. And again, live record is maybe the wrong word because this is in replay mode on my platform, but I'm doing what I want you guys to do. I've identified an example, I've gone back, I've downloaded the data, and now I'm watching it again so that I can get a feel for what happens when one of these continuation plays takes place. So before we even hit play, or before we even get into it, let's take a look at the volume profile that we're looking at on our chart. So this topside level that I had drawn my previous day got broken through on a good up candle, very nice bull candle on high volume. So good signal that we're probably going to continue. Additional good signal here on our volume profile is that we have a decrease in volume as we pull back. So at this point, I wouldn't be thinking anything other than, hey, we're probably going to continue to push up. And if I had my level 2, you would have seen that there were larger orders stacked up here as well. So now let's hit play and see what happens in our time and sales. So watch what happens as we pull back here. Notice that we're going to pull back to this level. Notice how little participation we have on our larger time and sales window. Okay, the large buyers are not panicking, and they're not going to step in until we actually hit that moving average, and then they step in again here as we hit our actual level, and you can see them buying. Okay, so we didn't get any participation from our larger sellers. We have this kind of decline in volume as we push back. And now I'm going to fast forward just a little bit here, and you're going to see what happens as we push away from this level. So we're consolidating at the level. Now, as we push away from this level, remember that what we want to see is increased velocity from both time and sales windows. So here we go. So watch this huge flash. Boom. Huge flash of orders on our large and our small time and sales on a nice up candle as we push away. And you basically continue to see that for the next several candles. Here we go again. Once again, we're pushing. Huge orders coming through as we push in price. So that would have been a perfect example where you could have taken a very tight risk reward ratio trade against this level for a push higher. Even if it was just a scalp on kind of these 3 candles, you would have had solid profit. Okay, so this brings us to our last scenario that we're going to learn about today, which is the weak squeeze or the weak flush. I include this scenario because in my own trading, I'm trying to avoid getting trapped in fake moves. And that's exactly what this key time and sales signal is going to teach you to avoid. So the whole premise around the weak squeeze, the weak flush, is that the order book, the daily trend, the other things that we've learned about in this course are all telling you that price should move higher, okay? But instead what happens is you get a quick flush down in price. And this quick flush down in price can panic a lot of traders to get out of their positions. It can keep them from entering positions when they should be going long. And it can FOMO some traders into thinking we're actually getting a reversal and we're about to flush completely down, only to then get trapped in the next move higher. So we are trying to avoid this portion, this weak flush. We're trying to avoid getting trapped there. And the same thing in reverse to the top side with a squeeze. So our key time and sales signals to avoid getting trapped are first when we see a high percentage of orders at the ask for a squeeze up or at the bid for a flush down. All right, so we see this huge flash of red if we're flushing down. But what then happens is there's actually lower velocity and lower volume both on the small time and sales and low velocity on the larger time and sales, okay? Once again, you're seeing this in kind of the opposite direction of where everything else tells you we should be going, okay? And so on the larger time and sales, you'll see either no participation or you'll only see participation when we have a support or resistance level hit that we can then use to push price higher. So this is a very, very common trap that is used by market makers and used by larger institutions to essentially stop hunt retail traders, get them to panic out of their shares, and then push price higher. So their goal, once again, is to rapidly drop or rapidly raise price to a specific level, fill a bunch of orders for themselves and for the institutional clients, take out the retail stops that are sitting there, and then allow price to move in the direction of the daily trend, in the direction of the larger order book. And we'll look at a key example of this now. Okay, so we've got our live recorded example here of AMD, and in this example, I want you to focus on the fact that at the time of this trade, or early in the morning here, we actually had large orders and a more bullish order book, like what we talked about in 1.6. So there were actually larger orders sitting up here around $84.25, $84 flat, $83.88. So there were larger orders up here. We're in a good position from a daily trend perspective for a push higher. So we got a strong move up on good volume. We then got a decreasing volume pullback to some moving averages. And we're setting up for what should be a strong, kind of continuation move up to 90, 92.5, 95 level. All right. Swing traders are thinking this. There's probably just longer term investors that are thinking this is a good place to get in. The order book is strong. Everything about this situation says, hey, I should be buying, I should be going long. But watch what happens when the market opens. What happens is you get this weak flush down to our pre-market low and our Camry levels. Notice that there's very low participation from larger time and sales until we get to this level where they're willing to pick up more shares. We get fairly low participation even on our lower time and sales. And as I fast forward here, you'll see, once again, let me just get a little bit further along. You'll see that every time we push down, there's just almost no participation. It's very weak. The only orders that are taking place are us flushing out retail traders so that we can then move price higher. So you can see all their stops getting hit right there. All right. Now I'm gonna speed this up pretty dramatically. But you can see once again, we get large volume. We get a very, very weak second attempt to push lower right here. So boom, look how low that volume is right there. And again, you saw very little participation except from our large traders willing to pick up more shares at this level. And now I've sped this up dramatically, but watch how they just rip price for basically the entire rest of the day in the opposite direction. Okay? So this entire first 4 minutes, if you were just watching this as an inexperienced trader, you probably would have been thinking that, hey, AMD is going to sell off. AMD is going to continue selling off. When in reality, all that's taking place is them flushing price very weakly down so that they can pick up more shares to then profit from the upside move. This happens all the time. It happens, to the top side. So if you just flipped this on its head and we pushed up and then flushed down, squeezed up and then continue to flush and sell off down, it happens again all the time. So be careful, watch out for this, and you can utilize your time in sales and the other things that we've talked about in previous lessons to identify this and not get trapped in fake moves. All right, everybody, I mentioned that there would be an appendix slide at the end of this lesson. Here it is. If you're not interested in how limit orders execute, feel free to skip this lesson. It is not information that you strictly need. However, it took me hours to uncover it and dig it up and get an actual solid answer to it. So I wanted to provide it here because I promise you will not find it anywhere else on the internet. So these examples explain that limit buys should be green prints and limit sells should be red prints. However, there are several reasons that this will not be the case, as I mentioned in the previous slides at the beginning of this lesson. Okay, so sometimes limit buys will flash across as red, sometimes limit sells will flash across as green, and you can tell they're limit orders because price is churning at that level, right? And there's clearly a lot of participation as price is completely stalled, right? That shows us that it's a limit order. However, as I show in these examples, and this is fact, this is SEC documentation, this is technical support for my platform and other platforms, you cannot argue with this. Technically, limit buys should be green for this reason. Basically what happens is you have step one, you put out a limit buy order, okay? So price is up here, this is the bid-ask spread, that's step one. In order for your limit to get filled, the ask price has to move down to at or below the limit price. And so therefore, this should be a green print, right? Because you are executing either at or below the ask. On the flip side of that, a limit sell order should be a red print because you have your limit sell up here above the bid-ask spread. And in order for this to get filled, the bid price has to be greater than or equal to your limit price. So therefore, you should be a red print. This is, again, per SEC documentation. You cannot argue with this. However, this doesn't always happen, and it won't happen in your platform. It doesn't happen perfectly in my platform. And according to DAS Technical Support, there are a few reasons that you could see mismatches in the colors for limit orders. The first are hidden orders that are actually higher or lower than the national best ask/bid price. So potentially, when your limit gets filled or these limits get filled, they're actually getting filled at a better price than what the ask and bid are currently showing. Therefore, they will print as a different color. Second, when dark pool transactions are recorded, they are eventually reported and they do eventually show up in your time and sales window, which a lot of people actually don't know, but they do have to get recorded. When they do finally flash across your time and sales, your platform and DAS will record them in relationship to the bid-ask spread wherever they're at, right? So they could easily show up as any particular color that we talked about in our previous slides because they're just being recorded. They're not actually going through at that particular time. Third, there could be tremendous amounts of market momentum and things moving extremely fast that will result in either the bid and the ask getting crossed or kind of just weirdness with how fast things are moving and how your platform is recording the price. that result in this mismatch of colors. Finally, there are technical platform limitations and data processing speed that could result in these orders flashing through, but your platform actually assigning them the wrong color. So, for all of those reasons and more, I focus on identifying limit orders by a large flash and kind of a large chunking through of orders on my time and sales windows as price is not moving at all, okay? So that's how you identify, a huge portion of limit orders moving through, because limit orders aren't moving the price, right? They're just getting executed, at the ask or at the bid. So that is our quick aside, or not so quick aside, on why limit buys should be green and limit sells should be red. However, that's not always the case, and now we can get on with closing this lesson. Okay, so that brings us to the end of our lesson on interpreting order flow. As always, I have a couple of quick thoughts to leave you with before we wrap today's lesson up. First, remember that this is a difficult skill, and you need to practice it as much as you can. The easiest way to do this is just isolate examples from your day, mark down the time that they happened, and then practice watching them in replay mode while you focus only on your time and sales window. Second, please don't get discouraged, as I've said multiple times throughout this lesson. This is a hard skill to learn, and many traders don't look at the time and sales window at all during their trading and are still successful. So it's something that you can do without if you have to. Third, and finally, try and focus on identifying which participants are involved, what their psychology is, and what the smart money is doing. That's the critical thing that you want to take away from your time and sales window. So with that, I hope this lesson was helpful, and I'll see you in the next one. Have a good day.